Welcome to Countards. In this lesson, we're going to be looking at the cost of giving up a cash discount. Here you're considering what is it going to cost you if you do not take the cash discount and rather use the money for other purposes. So here we are looking at a scenario where the supplier has told you if you pay within a specific number of days, we will give you a percentage of discount. And so why we are considering this is that sometimes you may want to use that money for something else and not pay the supplier early. So you're considering which one is going to cost me more. So if the cost of giving up the cash discount is greater than the cost of foregoing whatever else I want to use the money for, then I might as well pay the supplier early so that I don't incur the higher cost. Or if I'm considering paying the supplier, but I do not currently have the money and the cost of giving up the cash discount is actually higher than the cost of going to the bank and getting an overdraft, what will I do? I'll go to the bank, get the overdraft facility, and then use that to pay the supplier. That is why we are calculating what the cost is of giving up a cash discount. This is the implied rate of interest incurred to delay payment to a creditor for an additional number of days. Now, obviously, a supplier will tell you, if you pay me within 10 days, I'll give you a specific discount. Otherwise, if you don't pay me within 10 days, pay me back within 30 days as per the terms. So if you delay paying the supplier, what is the implied rate of interest that you're incurring? Well, there is another term for the cost of giving up a cash discount. A cash discount allows the buyer to pay a discounted amount to a supplier in exchange for settling invoices before a specified number of days. And we'll see what that looks like just now as we go through some examples. A supplier issues discount to encourage early settlement so that they may get cash flows. Now remember, the supplier is not being nice here by saying, you know what, I'm in the mood of giving discounts to my customers. But they also want to get money quicker, because the quicker they get money, the quicker they're able to use that money for other purposes. They may also have their own suppliers who are offering them cash discounts for early settlement. So what do? They are coming to you as the customer and saying, look, pay me early, I'll give you a discount. And then they will use that money to even pay their suppliers and also get a discount, or use that money for other purposes. So whatever the case may be, they are offering a discount so that they can get cash quicker. A customer considers whether to settle accounts early and take advantage of a settlement discount, or forgo the discount and use the cash for other purposes. A cheaper option will be considered, as I've just explained. All right. So if I want to use this money and the supplier wants me to pay them within 10 days, I'm considering which one will give me the better value for my money. So if the cost of giving up the cash discount is quite high compared to all my other options, then I'll just use the money to pay the cash discount. But if the cost of giving up the cash discount is lower than my other costs, then obviously I will forgo paying the supplier early and use my money for whatever the cheaper option is. Okay, so we'll see how this looks like practically with an example. But what is the formula of the cost of giving up a cash discount? Well, it's quite a simple formula. Here it is. The formula is cash discount divided by 100% minus the cash discount percentage, and you multiply that by the days in the year divided by the sum of full settlement days minus the discount days. Here's what it means. If you're given a cash discount of 3%, for instance, then your numerator here would be 3%, and then you divide that by 100% minus 3%. So it's going to be 3% divided by 97%, and then you multiply that by the number of days in the year. Usually you'll be told, assume 365 days in the year or 360 days in the year. And then you divide that by the full settlement days, and that is how long the supplier has given you according to the credit terms to pay the amount off if you do not take the discount. All right, so that's the full settlement days, and we minus the discount days, meaning how many days the supplier has given you to pay so that he can give you a discount. And we'll make sense of this as we go through the example. So when you're asked the question about cost of giving up a cash discount, how do they usually ask, or how is the credit terms presented? Well, here it is. They will give you something like this, where they will say 2/15 net 30. The amount might be different. It might be 3/30 net 60, or whatever the case may be. But this is how it's usually presented when you're asked a question about the cost of giving up a cash discount. So what do you do with this? What do these numbers mean? Well, the 2 at the beginning there is the actual cash discount discount you are given. So it's a percentage. So 2 days, the discount percentage given. That means in this case, you're given a 2% discount. And what does the 15 mean? Well, the 15 there means the number of days you have to make payment so that you can get the discount. So basically, you have up to 15 days to make payment so that you can get the 2% discount. So that is what it means, number of days within which payment can be made to take advantage of the discount. Meaning if you don't pay within the 15 days, you don't get the 2% discount. That's exactly what it means. And then net 30, what does that mean? Well, net 30 here means the number of days you have to settle the account anyway. So even if you do not take advantage of the discount by paying by the 15th day, you have 30 days to pay off the account regardless. All right, so the number of days within which payment must be made if discount is not taken advantage of. And you can see there I highlighted can for 15 days, meaning you can make payment within 15 days. It's up to you whether you want to take advantage of the cash discount, and that's why we are calculating it to see, is it more advantageous for us to pay the cash discount or not. And then for the 30 days, it is a must for us to make payment within 30 days for us to be in the good books of our suppliers, all right? Because those are the credit terms that you will be given, and that's how it's presented. So it's easy to plug this into our formula. Let's see how we plug in this particular presentation or this particular credit terms into our formula in calculating the cost of giving up a cash discount. Here's how it would look. Remember, the formula is cash discount. In this case, it's the 2%. And then we divide that by 100% minus the cash discount, which is 2%. So it's 100% minus 2%. And then we multiply that by the number of days in the year. Now, in this particular case, we were not given the number of days, so we'll probably use 360 or 365. All right. And then we divide that by the full settlement days. How long do I have to settle the account, even if I don't take advantage of the discount? Well, we have 30 days. That's why we wrote the full settlement days, where you have to settle your account regardless of whether you took advantage of the discount. So full settlement days is 30, and then we minus the discount days, which is the 15 days. Okay, so the days in the year 360 divided by 30 minus 15. And basically here for this denominator, you're trying to see how many days after I've missed taking advantage of the discount do I have to settle the account. All right, so that's going to be the 30 minus the 15 days. And so if we were to get the cost of giving up a cash discount under these credit terms as we have put here, what is that cost? Well, here is how you would put it in as we have just explained. We assumed a 365 days in the year. You will usually be given the number of days in the year. If not, you may assume 365 days or 360. Okay, and so here we can see that the cost of giving up a cash discount is 49.65%. Now, if you want to make sense of this, remember, we are trying to see how much is the cash discount of the real amount we would pay if we take advantage of the cash discount. And then we multiply that by the days in the year divided by the full settlement days minus the discount days. Now, if you think of this mathematically, we're trying to see if we forgo this discount throughout the year, basically how much is the interest rate implicit that we will be foregoing, and what is that cost? Well, we will be foregoing an interest rate equivalent to 49.65%. And that's quite high. You are unlikely to get this interest rate elsewhere. So in this particular scenario, if you're considering whether to take advantage of the cash discount or not, and maybe you do not have cash, well, you go to your bank and say, okay, what will the cost be if I take an overdraft? If the cost is going to be 20%, then what will you do? Well, you'll take a bank overdraft because it's only 20%, which is less than the cost of giving up the cash discount. You will go to the bank, get the cash, and then pay the supplier and take advantage of the cash discount. So this is what you will be doing throughout the year, because you know the cost of giving up the cash discount is higher than the cost of the bank overdraft. I hope it's made sense. Let's go through some examples here in making sense of everything we have explained. So let's bring up our formula again. Here it is, and here is the question. So what you can do, pause the video, attempt to do it on your own and get the answer, and then you can continue the video and gauge whether you have understood. Do this for this example and the second one. I think you'll be in a better position if you try it yourself before just watching. Okay, I hope you've tried it. Let's see. What is the cost of giving up a cash discount under the following credit terms? 4/10 net 30. Assume a 360-day year. Okay, so let's plug it into our formula. We know that the numerator is going to be the cash discount, so that's going to be 4%, and then divide by 100% minus the 4%, which is the cash discount, and then we multiply that by the days in the year. Well, we're told to assume a 360-day year, so we'll put 360 divided by the full settlement days. So that means if I don't settle within 10 days and take advantage of the cash discount, I still need to settle within 30 days. Okay, so we're going to take 30 minus the discount days, which is 10. Okay, so 30 minus 10, and this is how it's going to look. 4 divided by 100 minus 4%, and multiply that by 360 divided by 30 minus 10, and that gives us a cost of 75%. So if I do not take advantage of the cash discount throughout the year, I'll be incurring a cost of 75%. All right, so that's the interest rate implicit here, and you can see how high that is, and that is why you consider other options. Okay, so if I don't pay this supplier now, is it because I want to use the money for something else? And if that's the case, I will consider whatever I want to use the money for is going to pay me a higher interest than the cost of giving up a cash discount. Or maybe I do not have money. Again, I can do the overdraft facility as we've just explained. I hope it's easy enough for you to see how to do it. Let's do one more example. A company bought inventory on credit for 2,500 Rand with the following credit terms: 3/20 net 60. Assume a 360-day year. What is the cost of not accepting the discount? Well, here we did not have to even be given what the amount is, the 2,500 Rand, because we are given what the credit terms are. And if you are given what the credit terms are, obviously you can get the cost of not accepting the cash discount. All right, so let's calculate that. We know that we'll be given 3% if we settle within 20 days. Otherwise, the full amount is due within 60 days. So let's plug it into our formula. We know 3 is going to be our numerator, and then we divide that by 100 minus 3%, and then we multiply that by 360 divided by 60 days, which is the full settlement days, minus the discount days, which is 20, and that will give us an answer of 28.22%. I hope you are able to make sense of calculating this, and also the rationale behind it, why we are calculating it, and how to compare it with other costs and make informed decisions. All right, so as I explained earlier on, if you just take this second part of the formula, 365 divided by 60 minus 20, that will actually give you how many times you will have to pay your supplier if you don't take advantage of the cash discount. And so if it gives me the number of times here and I multiply it obviously by the first part just shows me how much discount I'm foregoing every time I don't take advantage of the cash discount, and you're multiplying it by the number of times you're paying the supplier without taking advantage of the discount, and that's how you get this answer of 28.22%. I hope it's made sense. I hope you've gained value from this lesson, and if you have, consider subscribing to our channel, like this video, and share it to those you think it might help. Please also consider joining our membership and supporting the work that we do. You'll also get access to all the documents that we've used in all our YouTube lessons, including the document that we used for this particular lesson. Till next time, cheers.